In early 2026, most crypto content still follows the same pattern. Channels highlight individual tokens, repeat short-term narratives, and focus on price targets. Very few explain how portfolios should actually be built. Topics like position sizing, correlation, drawdowns, and risk management are often ignored. As a result, many investors hold collections of unrelated assets without a clear structure or objective. Welcome to the Crypto IQ. Today we're stepping away from ticker-driven content. This video focuses on portfolio construction. The goal is not to predict which asset performs best, but to explain how different types of investors structure risk and how balance matters more than individual coin selection. In practice, most investors fall into one of three categories. Conservative investors prioritize capital preservation. Their primary objective is minimizing downside rather than maximizing upside. They typically allocate heavily to lower volatility assets and maintain high exposure to Bitcoin or cash-like instruments. Balanced investors aim to grow capital while managing drawdowns. They accept volatility but avoid concentration risk. Their portfolios are diversified across major themes rather than individual bets. Aggressive investors focus on asymmetric upside. They accept large drawdowns in pursuit of outsized returns. These portfolios carry higher exposure to emerging sectors, smaller market caps, and trend-driven narratives. Understanding which category you belong to is the first step. Portfolio structure depends more on risk tolerance than conviction. A useful way to visualize portfolio construction is the pyramid of risk. At the base sits Bitcoin. Historically, Bitcoin has shown lower correlation to individual sector narratives and has served as a liquidity anchor during market stress. For most portfolios, it functions as the foundation. Above Bitcoin, cite large cap platforms and infrastructure assets. These include established Layer 1 networks and core protocols that benefit from long-term adoption rather than short-term hype. They introduce more volatility, but also higher growth potential. Higher up are thematic allocations. In 2026, these include artificial intelligence infrastructure, real-world asset tokenization, and modular blockchain components. These sectors are driven by adoption trends and policy alignment, but remain cyclical. At the top of the pyramid are high-risk assets. Meme coins, microcaps, and early-stage experiments offer upside, but carry the highest probability of loss. These positions should be sized accordingly. The higher you move up the pyramid, the smaller each allocation should become. To illustrate this framework, consider a hypothetical $10,000 portfolio built around 2026 narratives. A balanced investor might allocate 40% to Bitcoin as the base layer. This provides liquidity, relative stability, and long-term exposure to the broader market. Another 30% could be allocated to large-cap platforms and infrastructure. These assets capture network usage and ecosystem growth without relying on a single narrative. 20% could be assigned to thematic exposure. This includes AI-related crypto infrastructure, tokenized real-world assets, and interoperability plays. These sectors align with broader economic trends but remain volatile. The remaining 10% could be reserved for high-risk ideas. This portion is optional. It is designed for experimentation rather than core growth. The key point is structure. Each allocation serves a role. No position exists in isolation. Stop buying random coins based on headlines. Portfolio construction is not about picking winners. It is about managing correlation, controlling downside, and aligning risk with objectives. In 2026, the investors who last are not those chasing every narrative. They are the ones who understand balance. Subscribe to the Crypto IQ. as we will come back again with another interesting topic.